If you watched part 1, you already know the US is deep in debt. And while it's been manageable so far, no system runs forever without pressure building somewhere. So the question becomes, what can you actually do about it? First, let's talk about signs. One of the earliest warnings that things are getting shaky is when interest rates rise rapidly, not because of inflation, but because investors start to demand more return for holding US debt. If you see long-term Treasury yields rising without a Fed hike, that's not a good sign. Another clue is a downgrade in the country's credit rating. It's happened before. In 2011, S&P downgraded the US from AAA to AA+. That triggered market volatility and cost billions in higher interest payments. Watch for that kind of headline again. So, what can you do? Start with asset diversification. If all your money is in US-based stocks or bonds, consider adding international exposure or commodities like gold. These tend to hold value when the dollar weakens or confidence dips. Second, build a real emergency fund. If the government ever delays payments, freezes programs, or stumbles into a shutdown, the ripple effects can hit your income or access to services. Cash gives you breathing room. Third, consider reducing reliance on adjustable rate debt. If rates spike as confidence wavers, the cost of your credit cards, HELOCs, or personal loans could jump fast. And finally, pay attention to policies, not headlines. If politicians start floating debt ceiling fights again, or major fiscal bills stall in Congress, it's not just political theater. It can lead to real market reactions and higher borrowing costs. This isn't panic, it's preparation. You don't need to predict the next crisis, just be positioned so it doesn't knock you over if it comes. You don't need to be rich to be resilient, just aware, flexible, and a step ahead.